One of the things I always teach in workshops is about how the media and the markets work together. Now, if you think about it, when the market's going well, things are going well in the stock market, the market's up, you always hear these glowing reports about the stock market, about the economy, all these great things that are happening. And vice versa. If the market's gone down, you always hear the gloom and the doom and how terrible things are and how terrible things are going to be in the future and so on and so forth. Well, this week was no exception. There was this article in the Tennessean this week, and it was entitled "The Vexing VIX." They said the stock market's main fear gauge is spiking again, suggesting that investors and traders expect prices to keep dropping. Now, that's actually inaccurate. The VIX is a measure of volatility. Now, you have two types of volatility, of course. You have upside volatility and downside volatility. What we've just seen is some downside volatility. Nobody ever worries about the upside variety, and that's why they use the word vexing, because the downside volatility tends to bother people quite a bit. Now, the second thing that they said in the article that raised my eyebrow anyway is it said it was talking about concerns about what was ahead in September. They said that's typically the worst month for stocks when the S&P 500 falls 0.93% on average. So they're talking about September is typically a bad month in the stock market. Well, in the academic circles, they'll call that data mining. In other words, looking for information in historical records or in the data out there that backs your point of view or a point that you're trying to make. And apparently the writer of this article was trying to make the point that the market's going to be bad, or that they think the market's going to be bad in the future. Well, I did some data mining of my own. What I did is I went back to 1927. And I looked at information on the S&P 500, just the 500 biggest companies, going back to January of 1927. But what I did is I broke it up into two groups. Number one group is the group of Republican presidents, and the Septembers where Republicans were president. And then I looked at all the Septembers where Democrats were president. And what I found was that when Democrats were presidents, when we had Democrat as a president, in the month of September, we actually had positive rates of return. If you think about it, right now we have a Democratic president. So does that mean that the market's going to go up in September because of that? Who knows? You got a 2/3 shot, as I always say, that the market's going to go up, and a 1/3 shot that it's going to go down. Number one. Number two, the other thing that you think about is this. If everybody knew that the market was going to go down in September, why would the people that are buying stocks right now, why would they buy them? Because you think about it, if people are selling stocks right now, there's always a buyer on the other side of the trade. Now, one of the things I pointed out in my show at one point was I was talking about just other predictors in the future, and one was butter production in Bangladesh. If we want the best predictor of the stock market historically, it's been butter production in Bangladesh. Now, we're not going to put a whole lot of stock in butter production in Bangladesh, nor should we put a whole lot of stock in the month of September or any other month for that matter. We'll catch you next time.